Public projects need money. Roads, schools, hospitals, water systems, governments have some money. Taxes, other public sources. Private investors also have money they wish to invest for a return. When private money joins public projects, it changes planning, financing, and management. This essay explains how that change happens. Specific steps, governing rules, fundamental trade-offs. This is not a simple transaction, it creates a complex system. Public goals and private interests meet. Sometimes they clash. We will explore this system with clear language and, simple examples. First, identify the players. Public side, local government, regional government, national government. This public entity sets the rules and public goals. They often own assets. They represent citizens' interests. Private side is diverse. Large commercial banks, specialized infrastructure funds, construction companies. They bring capital management skills, focus on financial returns, contractors, service operators. Citizens are the ultimate users. Regulators oversee the system to ensure rules are followed and public interests protected. Purpose, framed as a solution to a problem. The problem, shortage of public funds, budget constraints, borrowing limits, private finance promises earlier delivery of infrastructure, claimed benefits, efficiency, innovation, better management. Private partner, driven by profit motive. Expected, complete the project on time, on budget. Narrative, a win-win where public needs are met more effectively. But core purpose, transfer of roles and responsibilities. Government moves from direct funder-provider to client regulator. Private sector moves from contractor to long-term partner, financier-operator. This shift alters control over public services, who decides costs, who decides quality, who decides access. Understanding this shift is critical to know who benefits and who pays roads, schools, hospitals. The system is not neutral, it is designed. How does private capital actually join a public project? The money does not simply appear. It follows specific structured pathways. There are several main routes. One common path is a direct government payment contract. The government pays a private contractor in stages to build a project like a new courthouse. The capital is private in the sense that the contractor finances its own operations, but the ultimate source of repayment is the public treasury. A second, more complex path is the public-private partnership, often called a PPP or P3. Here, the private partner not only builds the project but also finances it and often operates it for many years, sometimes for decades. A third path involves the capital markets. The government or a special project company can issue bonds. Private investors, pension funds, insurance companies buy these bonds. This provides the upfront capital needed for construction. The investors expect to be paid back over time with interest. A fourth pathway relies on user fees. Private investors fund a project, like a toll bridge, a water treatment plant, and are repaid directly from the fees paid by the people who use the service. A fifth route is a mixed finance model. This approach blends different sources: public grants, government loans, private bank loans, equity from investors to make a project financially viable. Each of these pathways creates a different set of rules and relationships. A direct payment contract keeps the financial risk largely with the government. If the project costs more than expected, the government often pays more. In a PPP, the contract is designed to transfer more risk to the private partner. For example, the private operator of a toll road bears the risk that not enough cars will use it to generate the expected revenue. This is known as demand risk. The choice of pathway is therefore a critical decision. It determines who is exposed to what kind of financial uncertainty over the life of the project. The structure of these deals is not accidental. It is carefully engineered to meet specific constraints and objectives. Banks and investors have rules about the kinds of projects they will fund. They look for predictable cash flows and legal protections for their investment. Governments have political and legal constraints on how much debt they can take on or what assets they can sell. The chosen pathway is the one that best navigates these multiple, often conflicting, sets of rules. It is a financial and legal puzzle that must be solved before any ground can be broken. The solution to that puzzle sets the terms for decades to come. The contract is the central nervous system of any privately financed project. It's a detailed legal document defining payments, deadlines, quality standards, and penalties for failure. A key function is to allocate risks, like construction delays or changes in demand, to the party best able to manage them. But a contract is only as good as its enforcement. Robust deals require clear reporting, independent audits, and inspections to ensure compliance. Payments are often directly tied to performance, creating a financial incentive for the operator to meet public service goals. Let's now discuss incentives and risks. The engine of the deal. Private investors are driven by financial returns, while governments pursue public goals like access and quality. This creates a tension. Well-designed contracts try to align these incentives. For example, a waste management contract could offer a bonus for high recycling rates, making public good profitable. However, to attract capital, governments may offer guarantees, like for a toll road's minimum revenue. This can transfer risk back to the public if forecasts are wrong. Let's now move into delays, loops, and real-world examples. Delays can fundamentally change the outcome of a project. The process is often long before construction even begins. Securing approvals, negotiating contracts, arranging finance can take years. Each month of delay adds costs, particularly interest costs on committed money. Construction delays have a similar effect, increasing the final price tag. But delays can also have more subtle impacts. A new transit line delayed by 5 years may arrive in a neighborhood that's already changed. Businesses may have moved residential patterns, may have shifted meaning the project no longer meets the original need. Effective deals must account for time with clear penalties for delays. Feedback loops are powerful. A positive feedback loop can amplify success. If a privately financed toll bridge cuts travel time, more drivers will choose it. Increased traffic leads to higher toll revenues. Higher revenues make the project more profitable for investors. That success helps attract private capital for other infrastructure projects in the region. The initial success creates a cycle of positive reinforcement. This is the ideal scenario proponents hope to achieve. However, negative feedback loops can be just as powerful and damaging. Consider a water system privatized to improve efficiency. To increase profits, the operator raises water rates significantly. Lower-income households reduce consumption or, in extreme cases, are disconnected for non-payment. Revenue falls. The operator may cut back on maintenance to save costs. Infrastructure deteriorates, water quality declines, service interruptions increase. More users become dissatisfied, eroding public trust and operator revenue. The downward spiral harms the public and can lead to project failure. Real-world examples show these mechanisms in action. The Canada Line in Vancouver was built as a PPP. The private partner handled design, construction, financing, operation. The contract had strong incentives for on-time completion. The line opened ahead of schedule for the 2010 Winter Olympics. Conversely, many toll road projects in the US and Australia faced financial trouble after overly optimistic traffic forecasts failed to materialize. Governments sometimes had to bail out the projects or buy them back, with taxpayers footing the bill. These examples show the model is neither inherently good nor bad. Its success depends entirely on the deal details. There are major headaches to consider. Common failures and system-wide effects. Despite careful planning, projects with private finance are prone to common failure modes. Poorly defined contracts are one of the most frequent failures. Vague service requirements create loopholes that private operators can exploit to cut costs at the public's expense. That leads to disputes and services that don't meet expectations. Weak monitoring is another common failure. Without strong independent oversight, governments can't reliably check if partners are delivering. Poor performance can go undetected and unpunished. Overly generous guarantees are a classic mistake. In the rush to sign deals, officials may shift too much risk to taxpayers. Guarantees can protect private partners from downside. Investors get the profit while the public bears the loss. Wildly inaccurate demand forecasts are a recurring problem. Consultants paid by promoters may produce optimistic revenue projections. When reality falls short, projects fail financially or need public bailouts. The fixes are straightforward in principle. Clear, detailed contracts, precise performance metrics, strong monitoring agencies, well-funded monitoring agencies, independent monitoring agencies, realistic, independently verified forecasts, forecasts for costs, forecasts for revenues, fair and transparent allocation of risk, not offloaded onto the public balance sheet. Implementing fixes needs political will and technical capacity on the public side. Information and expertise asymmetries between governments and global finance groups can be immense. Beyond individual failures, private finance can have system-wide effects. It can speed up infrastructure delivery when budgets are tight. It can also increase total lifetime costs, because private capital usually costs more than government borrowing. It can change who controls essential public services, shifting power from elected officials to corporate boardrooms. That can concentrate market power in a few big firms, reducing competition and public accountability over decades. These larger effects are complex and unfold over decades. Now for the conclusion. An unresolved tension. Bringing private money into public projects creates a fundamental tension. The private partner seeks profit, while the public partner defends goals like access and quality. This tension is never fully resolved. It is managed through contracts. This leads to a central paradox. The model is often used to help a cash-strapped state, yet its success demands a strong, capable state to negotiate fair contracts and monitor performance. Ultimately, where the balance is struck between private profit and public good is not a technical matter. It is a political choice that shapes our shared future. You've been watching System Atlas. Share your comments below. See you in our next episode.